This show is produced by the Hartman Media Company. For more information and links to all our great podcasts, visit hartmanmedia.com.
I'll tell everybody this. Your advice for entry-level investors is phenomenal. Don't change a thing about that. That works 100% for the entry-level, the small investor. Your advice for those people is the best I've seen out there. I mean, just don't change anything about it. You're spot on with your listeners.
Welcome to the Creating Wealth Show with Jason Hartman. You're about to learn a new slant on investing, some exciting techniques, and fresh new approaches to the world's most historically proven asset class that will enable you to create more wealth and freedom than you ever thought possible. Jason is a genuine self-made multimillionaire who's actually been there and done it. He's a successful investor, lender, developer, and entrepreneur who's owned properties in 11 states, had hundreds of tenants, and been involved in thousands of real estate transactions. This program will help you follow in Jason's footsteps on the road to your financial independence day. You really can do it. And now, here's your host, Jason Hartman, with the complete solution for real estate investors.
Welcome to episode 1963, and thank you so much for joining us today. Today, we will have an interview of me being interviewed by Joe Brown, who's been on the show before, and he was also one of our great keynote speakers at Empowered Investor Live. And I just thought it was a useful interview with a lot of good information. And if you do get to catch it on video, there's some good visuals as well if you catch it on our YouTube channel. But if not, on the podcast, we cover it quite well as well. So enjoy that. And the only thing I wanted to let you know about other than that is that we have our upcoming Alabama property tour at the Empowered Investor Live event recently. A lot of you had asked for a property tour of this market, and we will actually be covering 2 cities on this tour. So you really should join us for the Alabama property tour coming up very soon. Just reach out to one of our investment counselors or go to jasonhartman.com, and we would love to see you there at the Alabama property tour. And let's go to the interview with Joe Brown.
So Jason, thank you so much for joining me here today. Very excited to talk to you about real estate. We're going to have some contrarian views. Most of the people that I talk to are predicting a crash, hoping for a crash, and get a little bit upset when anybody says that there's not a crash coming. So I'm excited to hear about the fundamentals from somebody who is deep in the industry.
Sure. And Joe, it's great to see you again, buddy. But I got to say, it is just funny how there's this huge contingent of people who just want the world to end. They want the market to crash. Mm-hmm. And, I get it. I mean, they think it's an opportunity. Maybe they missed out and they feel like, gosh, if the market crashes, it'll finally be my opportunity. And, we'll get into some fundamentals. I've been doing this a long time. I mean, I've got 3 decades of experience under my belt, watching my mom investing as I was growing up and really being a very financially attuned kid and doing it myself. And for thousands and thousands of clients, I've been involved in almost 10,000 real estate deals. So a lot of experience there. On my podcast and YouTube channel, I get to hear the feedback and read the comments just like you do from my audience. And it's really kind of amazing how human psychology works. And it can be an asset to us, or it can be a real hindrance in our success, so we've got to we've got to have control over our emotions and our thinking on that. And if you take a contrarian view, I can just feel the hate comments coming in now.
Sure. Absolutely. Yeah. So you've been doing this a very long time. You've seen the markets go up and down. You've seen all of the different markets that are everywhere. And that's something that I'd like to hear you talk about, because there's not a real estate market, right? There are real estate markets.
Yeah. Well, I remember my first trip to Europe as an adult. I was born in Europe, but my first trip to Europe as an adult, I went with a buddy of mine. We rented a car and we drove all around Europe, like 3,000 miles on this trip, right? Mm-hmm. And I remember during about lunch, we drove through an entire country, Luxembourg. And in that country, there is a national real estate market because it's so small. In a country as large and diverse as the United States, there's no such thing as a national housing market. There are about 400 what they call MSAs, or metropolitan areas. There are over 3,100 counties in the U.S. and over 9,000 cities in the U.S. And according to Obama, there's like 57 states. So, it's a big country and it's very diverse. And, to your point, we have to realize that there's, all real estate is local. There's no such thing as a national housing market. But in order to help analyze things, we can, I believe, break it down into 3 types of markets. And the first type would be linear markets. The second would be cyclical markets, and the third would be hybrid markets. So that just is in between the two, as the name would imply. So linear and cyclical, that's the ones we really want to talk about. Linear markets are the markets I like to invest in for my own portfolio, and I like to help clients invest in these markets. Because if you're looking at a chart, Joe, of appreciation over time, it's a very steady chart. It has little ups and downs, but they're not very pronounced. The peaks are not so pronounced. The troughs are not so pronounced either. The other kind, in contrast, is a cyclical market. Like where I grew up in Los Angeles, that's a cyclical market. And the peaks and valleys are just extreme. It's like a roller coaster if you're looking at the chart. And so those are the differences. How do we know what a cyclical market is and what a linear market? Well, cyclical markets, number one, get all the news media attention. And the Case-Shiller Index, the main index that's probably the most quoted index, or at least one of them for real estate values, only profiles 20 markets. And guess what? 15 of the 20 markets in the Case-Shiller Index are cyclical markets.
Cyclical, right.
So 75% of that entire index is cyclical, only 25% is hybrid or linear. So you're getting a very skewed view when you listen to the mainstream media. You can have a lot of blind spots and you can miss opportunities, or you can lose money by taking the wrong opportunities. So that's the first thing to understand. Cyclical markets, a little more on that. These are the markets, the high-flying markets that get all the attention. In the U.S., they're markets like where I live, South Florida. I live in Palm Beach, Florida, but Miami just south of me, that's a very cyclical market. The expensive northeastern markets, New York, Washington, D.C., Boston, Massachusetts, those are cyclical markets. The West Coast of the United States, pretty much almost the whole West Coast is cyclical. But everything else is linear or hybrid. So the vast majority of the land mass is not cyclical. And around the world, the cyclical markets are all the trophy markets: Paris, London, Dubai, Hong Kong, right? Those kinds of markets. Okay. Most of the world and most of the country is linear, right? But it gets very little attention because it's not newsworthy. Look at the news media wants to report on things where there's something going on, where there's something extreme, something sensational. And this is why these boring linear markets just don't get a lot of attention, but they are the best markets in which to invest.
This is almost like what you talk about, the dog that doesn't bark a lot. It's like news is something that's happening. That's what news is. And if it doesn't do anything, there's no news. If it doesn't do anything other than slowly go up, then there's no news there to talk about. So it's ignored because there's nothing happening other than making people rich, right?
I really like the way you said that. That's exactly the definition of news. That's a very good point that you made. Yeah, excellent point. Oh.
So another way that you break down real estate, or real estate is broken down, is between single family and multifamily. These are very different as well in terms of the supply and demand dynamics, which we all know supply and demand drives price. Can you talk about that?
Right. Yeah, absolutely. And that's a good question, because of course there's many types of markets. We talked about the geography of real estate, but you can segment by price, by condos or single family or multifamily. You can peel this onion a whole bunch of ways. Okay. But single family and multifamily, They act pretty differently. And what's happening in multifamily now is that there's been so much funding, and it's so easy to build multifamily because you can build an apartment complex with 400 units pretty quick. Building 400 single family homes is not going to happen that fast.
Right.
Okay. So the multifamily housing, and everybody knows this because if they just drove through any American city recently, they saw a whole bunch of 4 and 5 story apartment complexes being built, right, over the last several years. So those are oversupplied. And if you're an apartment investor right now, if you're a multifamily person, be careful. That has had a great run, but it is definitely oversupplied. And the interesting part about that is that when they talk about rents, okay, see, one side of the equation that most people focus on is, where are the prices going, right? But that's not really what true investors focus on. Speculators focus on that because, buy low, sell high, right? That's the whole game. But real investors focus on yield, they focus on income. If it's in the stock market, they focus on dividends, right? So this is investing, not speculating, right? That's what we recommend. So when you look at rental statistics and you hear, rents are going up like crazy, like they have been, or, rents are softening and now the rental market is soft because it's oversupplied, or whatever you're hearing in the news, right? What you have to understand is that the vast majority, and I don't know the number, I don't know that anybody really does, but maybe 90% of those rental statistics are weighted to multifamily housing. How do we know this? Well, here's how we know, folks. I mean, any of you listening to this who own single family rental properties at any time in your life, I'll bet. I mean, listen, if someone call me on this bet, I'll give you $20, okay? If I'm wrong on this, okay? I don't want to say 100 because too many. For the first 10 people that call me out, okay, I'm going to limit this to $200, right? Because you never know. But look, no one ever called you, I bet, to survey you on how you're single. Look, I've had over 600 units in my life, okay, that I've owned directly, right? And nobody ever called me on the single family homes to say, hey, Jason, how are your rents doing? Did you raise the rent this year when you renewed the leases? Is the rental market really strong or is it really soft? Are you having to give incentives to rent your properties, or are you just, is a landlord's market where you can command whatever you want? You have pricing power. No one ever asked me that question because they don't survey single family mom and pop landlords. Right. There are companies that do a very good job of surveying all the big institutional apartment complexes, and they ask them what's going on with your portfolio, what's going on with your rents, and then they share all this data into the marketplace. So that's another blind spot right there.
Yeah. I mean, from a data aggregation standpoint, you're going to get more bang for your buck if you survey one company that has thousands of units versus, you have to, go to single family mom and pop landlords one at a time just to get one more piece of data. So that makes sense.
Absolutely.
But
you can call Equity Residential, right? Sam Zell's company, and talk to their people, and they'll just tell you what's going on with their entire portfolio. And you can call the Irvine company, Donald Brenn's company in SoCal, and you can get your answer really easily. You don't have to do a giant survey. Absolutely.
Right. And this is significant because single family is undersupplied right now, right? And that's something most people don't understand. Single family is undersupplied.
Well, sort of.
Okay, break that down.
So here's where that gets a little more complicated. Generally speaking, you're right, because I know where you're coming from when you say that. But if I didn't know where you're coming from, you might be right or wrong. And here's why. Number one, you've got to differentiate between new and resale properties. And this may be the first time really in history, at least that I can think of, that this has been an issue, and we'll get to that in a moment. But number two, of course, and this is much simpler, you've got to segment between price ranges. Okay. So what you're talking about when you say it's undersupplied, and what I'm talking about, because I live it every day, and you pay attention to this market too, and this is what investors pay attention to, is the entry level housing market. These are the properties that make sense for rental, long-term buy and hold rental property investment. Okay, the entry-level starter home that, nowadays, maybe that's going to be a $350,000 house. It's not as cheap as it used to be, but adjust for inflation and the number's a little different too, but whatever. So the entry-level housing that is the sensible property where the rent to value ratio is going to be good and favorable to the landlord, to the investor, that is very undersupplied. And why? Well, because for the last 14 years coming out of the Great Recession, nobody's been building it. Okay. Right. And when I say nobody, it's a figure of speech, folks. Do not write a bunch of stupid comments, please, about this. Okay. And do not, send me a bunch of hate mail. I know some builders build like entry-level housing, but it's a drop in the bucket. It's nothing in the overall scheme of things. It's very undersupplied, just like Joe said. Now, in the mid and higher tier properties, that's a whole different ballgame. And the reason you have this is, look, it's just simply not profitable for a builder to build a $250,000 house anymore.
Right.
They can't make money doing it, so they're not going to build it. And why can't they make money? Well, one thing that would help is if the stupid government got out of the way, because they've just piled on so many regulations. It's so expensive for these builders to build anything because they've got to comply with just a million new code regulations. And this is what's just exacerbating the homelessness and the affordability problem. So
now, I want to clarify something there. So you're saying that hypothetically, if somebody was 100% ignoring the law, they just went out to a lot and just built a property,
they'll go to jail.
Cheap. Well, number one, they would go to jail. So this is hypothetical, but it would be pretty cheap, and you could do that and do it profitably. But because of the local regulations and zoning laws and things like that, and monetary policy, the manipulation of money, we've gotten to a place where it's not profitable for companies to build cheap homes anymore. And so the only homes that are getting built are the ones that only the rich people can afford.
Well, not even rich, but it's profitable for a builder to build a $600,000 house. Okay, you can build a $600,000 house and make money as a builder. You can certainly build $1 million or a $2 million house and make money as a builder, but you can't build a $250,000 house. I mean, to any scale. Okay, there are a couple builders that are building these things around the margins, but you're not likely to find those in areas with high regulation issues. So areas that are natural disaster prone are much more expensive to build in, and areas with left-wing politics are much more expensive to build in. So the Socialist Republic of California, my former home state for most of my life, it is just 29 environmental impact reports, and fight with all the neighbors that don't want you to build anything, and a bunch of litigation before you even get to the starting line. It's just beyond ridiculous, right? And these protectionist zoning laws, like you alluded to, years ago I had the great, he's retired now, but the great Thomas Sowell on my show. And he's a brilliant guy, used to write for Forbes, he's written a bunch of great books, a real intellectual. And during that interview, I actually coined a phrase in talking to him. I called it environmental racism. And I noticed this because when I lived in Newport Beach, California, the neighbors, people wanted to develop an area called Crystal Cove, which you may be familiar with. And the neighbors were just outraged. It's like, oh my God, we can't have development. We got to preserve the open space, right? And what that really is we've already got our homes. We don't want to let anybody else get a home here. Right. And that's exactly what it's, the NIMBY syndrome, the not in my backyard syndrome. Right. Yeah. And so that just pushes the values of their houses up because they limit and constrict supply. And this is very unfair. You'd think if people were so liberal, they would want to open the opportunity up for more people. But that's absolutely not true. I just check with the people on Martha's Vineyard.
Exactly. I was going to mention that. Yeah. Okay. Yeah. So that for single family entry level homes, because of the scarcity, it's an attractive place to be as an investor. Yeah. Now, what about the situation for the average household with 2.5 kids and a dog, and they're living in a house right now. They bought it within the last couple of years because most people tried to buy a home when interest rates dropped, and now they're looking and they're hearing the media talk about a real estate crash, and they're getting scared, and they're thinking of trying to sell as interest rates are skyrocketing. What does it look like is happening for the single family homeowner right now on average?
As a seller, a potential seller?
Potential seller, yeah.
Okay, I thought you were going to say buyer, and I was going to have a really smart aleck answer for you that relates to some
let's
of
do
your
that
prior
first
episodes.
Then. How about a buyer?
Yeah. The buyer example, I was going to say you'll own nothing and you'll be happy. Okay. So they're going to stay in the renter pool, and that's going to push rents up for the buyers. But for the sellers, that brings me back to the point we were talking about earlier, because we didn't yet distinguish between new home construction and resale existing inventory. And people need to be careful when they listen to and read statistics and surveys in the media, because are they talking about all houses, or are they talking about new houses or resale houses, right? These very different. And the new homes and resale, I mean, for the first time probably in history, at least that I know of, there is going to be this giant dichotomy between the two now. Here's why. Virtually everybody in the country, there's about 140 million units in the housing stock of the country, okay? And virtually everyone refinanced their house when we had these artificially low COVID fake interest rates, okay? And 25% of the country has a mortgage for 3 decades below 3%. Those people are going to beg, borrow, and steal to never sell that house, because the minute they sell that house, they're going to lose one of its biggest assets, the mortgage.
Right.
Okay. They're going to do whatever they can to hang on to those houses. They're going to turn them into rental properties. If they get into bad times, which they're kind of unlikely to do because their mortgage is such a low burden. I mean, yes, of course, they might have student loan debt. They might have other problems in their life, medical bills, who knows, right? Everybody's got stuff going on. But their mortgage, which is usually the most expensive thing people have, right, is super cheap, and it's got 28 to 29 years left on it.
Right.
So that's the poison pill that Jerome Powell put into the housing market. He created a poison pill that is going to constrict housing inventory for decades to come. And these people are just not going to want to loosen up on their houses because of their debt stack, right? It's just 28 to 29 years left. However, the complete contrast is new home builders. Complete opposite, because they don't have that long-term debt. Now, some of those home builders will and already have lined up long-term debt, and they're converting their properties to rental properties, or they're selling them to the big institutional landlords. Like JP Morgan just did a thing where they raised over $1 billion to buy single-family homes. And so these big institutional investors, BlackRock, Invitation Homes, American Homes for Rent, yada, yada, there's a whole bunch of them, own just tens of thousands of single family homes, which is a new thing coming out of the Great Recession. That wasn't ever really a thing before. And entire housing tracts that they'll go buy from builders, like some of, say, D.R. Horton's inventory, it never even comes on the market. Invitation Homes just calls them up and says, hey, can you build 300 houses for us? We'll just buy them. You don't need to hire a salesperson. You don't need to open a model complex or do any marketing. We'll just buy them from you, right? And so some of these do just turn into long-term rentals one way or another, but most of the time they've got to sell that inventory. So the builders are cutting deals. And I think the deals might even get a little better. We'll see. Okay, we don't know for sure. But Joe, I'm on like every list because we help people buy properties all over the country. And I get all these emails, and so does our investment counseling team every day. Today, we got a thing that says, go visit all these new homes and we'll give you a cookie, a different kind of cookie at each property. 2 weeks ago, they had pumpkin pie and Prosecco was their promotion. and $15,000 in incentives. We'll buy down your mortgage, free upgrades. The builders are making deals, and that's where the opportunities are now. The resale homes, there's like no supply. Who's going to sell those properties? I mean, like everybody, the media, they deceive people in so many ways. Because, if you've seen some of these articles on foreclosures, they'll say, well, the foreclosure rate has gone up by 40%. Oh,
from zero.
So it went from like 10 people in the country being foreclosed on to 14.
Right.
I'm joking, of course, but it's so low. It's like not even worth talking about.
Yeah.
And it's probably never going to get very high with those cheap mortgages.
Right. Yeah. When in doubt, zoom out. And when you look at those long-term charts of a lot of the stuff that we've been talking about, you notice that, yes, there has been a spike over the last year, let's say. But then when you look at that in the context of 10 years or 20 years or even longer, it's nothing. It's absolutely nothing. It's not even yet back to normal, let alone getting worse.
Yeah. The debt burden of 25% of the country of homeowners is insanely low. And I'll just share one more thing on that. Mm-hmm. We talked about the 25% with mortgages below 3%.
Right.
But the next tier, the next cut, is 65% of the country that has mortgages below 4%.
Wow.
And guess what else? 40% of all the homes in the country are free and clear. They have no mortgage at all.
So
where is the distress going to come from?
Right. In the situation right now where you have so many people with either very low mortgages or no mortgages, the situation where you'd have everybody just deciding, I need a panic sell right now, there's no mechanism by which that would take place. Yep. Because if they do that, then what they're buying will be way more expensive than what they currently have.
Right. So that's going to create a stagnant market. And you know who that's bad for? That hurts the economy because it's bad for realtors. Mm-hmm. It's bad for lenders. Like, who's going to refi out of a 3% mortgage? Okay. Right. Right. So it's bad for title companies. Now, who it's actually good for is remodelers, appliance manufacturers, and people that do home improvement, Home Depot and Lowe's. And by the way, I called that during the pandemic, that the home improvement business would just boom, and it's going to continue to boom. So people are going to stay in the same house. They're going to fix it up. They're going to add a room. They're going to, build a second story and a nice master bedroom up there. They're going to remodel the kitchen and bathrooms. They're going to do home improvements, but they're going to stay in that same house because the mortgage can't be moved with the house.
That's a fantastic insight there. That's like the story of the man that got rich during the gold rush in California by selling picks and shovels. It's like,
Levi's.
Yeah, exactly. Yeah. So it's similar to that, where looking at, okay, where is this going to lead? Well, if people are stuck in their homes are not things that naturally get better over time. Homes are things that naturally break over time. So at the very least, you've got maintenance and fixing. And if you need to upgrade, you're not going to be able to move. So you're going to have to do some major renovations. That's a good insight there. Now, I would like to hear you break down your the Case-Shiller Index versus the Hartman Comparison Index, because I know you have this real estate index. We've talked about the flaw with the Case-Shiller Index. What does the Hartman Comparison Index specifically look at?
So, I always talk about a couple things on my show. You've alluded to one, you can't hear the dogs that don't bark, which is an important concept in life that, the profound impact of things that don't happen, right? That's important, but nobody ever thinks about that. What didn't happen. They always think about what did happen, right? So that's an important concept. And a related concept to that I talk about a lot is just asking oneself the question all the time, which I think we just do internally, constantly, every day, 1,000 times a day. We ask ourselves, compared to what? Compared to what? And I thought, why is it that with real estate, all of these indexes, they seem to have all these flaws? And so I created a new index called the HCI, or the Hartman Comparison Index, to compare real estate to a whole bunch of other items, because most people are just comparing the price of real estate to one thing, the US dollar.
Right.
And as you teach your audience, that's a moving target. Okay. So we can't just use the dollar. That's like a totally bad measuring stick, right? It's one measuring stick, and that's fair, but it's only one of what should be many. And in the Hartman Comparison Index, we now have like 42 items. Okay. So we compare the typical price of a single family home to gold, to Bitcoin, to rice, orange juice, haircuts. Okay. Yeah. To the S&P 500, to oil, to a whole bunch of items, right? Because what we're always doing when we have money that we're trying to decide how to deploy or spend, we're asking, what is the highest and best use we can get out of this money, right? So if we deploy it as an investment, where are we going to get the best return, obviously? If we deploy it as a consumer item, where are we going to get the best return on, hedonism or happiness out of the item, right? And so the index attempts to answer that question. And surprisingly, real estate is much less expensive than most people think. If you compare it to gold, for example, okay? And of course, in 1971, Nixon took us off the gold standard. But back in 1970, gold was $35 an ounce. At the end of the decade later, in 1980, it was $653 an ounce. And the single family home in 1970 was about $23,000. And by 1980, 10 years later, it almost tripled to just over $63,000. But priced in dollars, everybody thought it was expensive. But priced in gold, it told a totally different story, because in 1970, if you wanted to buy the median single family home, it took 654 ounces of gold. But in 1980, it only took 97 ounces of gold.
Right.
And today, it takes about 227 ounces of gold to buy the median priced home. So compared to what more recently? Well, in 2010, when houses were really cheap, okay, it took 158 ounces of gold to buy the median price house. So the median price house in 2010, 12 years ago, was $171,000. Gold was $1,079. 158 ounces would buy the house. So think about it this way. If you were saving money to buy a house, every time you got your paycheck, you could either just put it in a savings account and let inflation and taxes attack it, or you could buy gold, or you could invest in oil, or you could invest in rice, which is 2/3 of the food stock of the world for 2/3 of the people on Earth. You have a choice. You could put it in the S&P, right? So that's what we have to think about, is how we store our wealth as we get it. And then when we want to make that purchase, we're going to convert it back to dollars, right? It's like the crypto people. We're going to take it off the exchange, sell the Bitcoin, convert it to dollars, and then buy stuff, because you can't really use Bitcoin to buy stuff in any real way. So that's what the index does. And I'm happy to dive into some other examples if you like.
Well, that's really key to know, that it's not as expensive as it's ever been when compared to a lot of these things that have had pretty stable values for a long time. And it's not as cheap as it's ever been. So when you talk about a bubble, just because prices are high doesn't necessarily mean there's a bubble. Like you said, you always have to ask the question, compared to what? And the example, I have to provide some context for the haircut example, which is genius, because when you have something that doesn't get cheaper from technology over time, the price, as priced in labor and man hours, stays the same. So a haircut today costs the same amount of labor as a haircut did 10,000 years ago.
It's a great example.
Take somebody with a blade to stand behind you and cut your hair.
Exactly. So let's go over that example. I got it right here on my screen. Okay. So in 1970, the median price house, if you were a hairstylist or a barber, you would have to do 9,234 haircuts to buy a house. Okay. If you wanted to not buy the house, you could get 9,234 haircuts. Okay. Today, as of August of this year, it took 10,264 haircuts.
Wow.
Okay. Now let's go back to 2010, because houses were cheap then. 6,087 haircuts.
Okay.
So we looked at the price of a haircut over time, and we looked at the price of a house over time, and we just did the math, right? And another comparison in the index is inflation. Right? Like, you have to compare it to inflation. What's the real value of the dollar? And we do that two ways. We basically take the CPI, which I call the CP lie, okay, because it is just such a giant lie. And then we also do it the old way. We use shadowstats.com, and John Williams, the founder, has been on my show. He's not doing it his way. He's just doing it the way the government used to do it before 1980, right? That's right. All he does. So what's interesting to look at here is the mortgage payment, not the price of the house, because that's the other thing we didn't say yet. Who cares about the price of the house? Most people don't pay the price of the house. They pay the monthly price of the mortgage. Right. Okay? And the interesting thing here is if you adjust the mortgage payments over the last 52 years, because we go back to 1970 on everything, okay? The median price house in 1970, the mortgage was $127 a month. Today, it's $238 a month adjusted for the CPI. And by the way, the not adjusted number in nominal dollars is $1,810. Compared to 127, okay? And I know it may be hard to follow these without visuals, okay? But anyway, if you take the way the government used to calculate inflation, the mortgage payment on the median price house, 1970, still $127, let inflation occur, and 52 years later, the price today is $70.
Okay, so let me make sure that I get that. So if you follow the official inflation numbers, which are almost certainly understated, then the cost in inflation
looks higher.
Dollars looks a little bit higher.
Right. Because they said inflation dollars, was less than it really is. Yeah.
Exactly. Right. And so in regular dollars, it's gone up a lot from 170 to 1800. But when you adjust it for inflation, if we were using the old dollars at the way they calculate inflation, it would be $250. 200 something. 238. Yeah. But when you calculate inflation correctly, or most likely more correctly, it's actually gotten cheaper.
Yeah, it has. And I know that amazes everybody, because everybody now, the riot started, okay? The tomatoes are being thrown at me because nobody believes that, okay? Yeah. But here's the thing, folks. The house of today is a lot better than the house of 52 years ago. It's a different house, okay? And you know what? We don't even have to try and figure that out qualitatively. We can just figure it out on a per square foot basis, okay? So in 1970, the median house was 1,500 square feet. Today, it's 2,300 square feet. So the size of the house increased by 157%, okay? Or sorry, it's 157% of the other house. Okay, 57% larger. Okay, so when you look at it that way, real estate is not nearly as expensive. It's what happened is we've all come to expect so much. I mean, look, folks, if you were alive in 1970 and you weren't, a toddler, okay, and you remember how life was, I mean, just remember how dinky your house was, and how the quality was really bad compared to the house you live in now, okay? And, it didn't have high ceilings, and it didn't have double pane windows, and it didn't have, forced air, HVAC, and air conditioning, and all that stuff, right? It's just a way nicer house, okay? It's just, you could adjust for hedonic indexing, right? But we've done that in our mind. We just expect so much more than we ever got. We just keep raising our expectations, which is fine. That's what creates progress, and that's good to an extent. That's what happens.
Yeah, absolutely. So in summary here, when you look at the mechanics, the fundamentals driving the industry, from an investor standpoint, there are certain areas that you need to be careful of. There are certain areas that are oversupplied, certain deals that might be coming up because there are, potentially builders that are forcing to sell at better and better deals for the buyers. Looking at entry level, supply is very tight. Looking at the people who are waiting to buy and are renting right now, they might be locked out of housing and become a renter forever. The people who are looking at selling right now are forced to look at houses or mortgage payments that are way more than what they're currently paying, so that it's going to be hard for them to actually sell if they want to. And so it's important to keep in mind all of the things that we buy, spend our money on, invest in life, and say compared to what, because if we just look at what the mainstream media is telling us, we might get scared into making a decision that's actually not financially wise.
Joe, I might share one thing with your audience just real quickly before we wrap it up. And that is what's called the mortgage sensitivity index. We publish this as part of the Hartman Comparison Index, because when mortgage rates go up, how many people can no longer afford to buy a house? That's the question. And those people are now forced to stay in the renter pool. And if they stay in the renter pool, that obviously puts upward pressure on rents, right? Now, I know everybody thinks rent is really high now, and it has it's taking a little bit of a breather at the moment. But look, the long-term mega trend is rents are going way up, folks. You ain't seen nothing yet as far as rents. I'm not saying it's happening tomorrow. The market is definitely readjusting right now in many ways. And there's kind of this standoff between buyers and sellers at the moment. But let me tell you something, that won't last. Money always comes off the sidelines. It always has to find a place to go. Everybody lives by T.I.N.A, T-I.N.A. There is no alternative. They just look for the best alternative. It's not as good as it used to be. I get it. But the money comes off the sidelines and it deploys. Okay. And people will start buying. But renters, okay, literally at the end of January of this year, 52 million people could qualify for a mortgage on the median price house. And 76 million people could not. Okay. Today, at 7%. Okay, so mortgages, give or take, I could say 6 or 7%, whatever you want. Okay, but let's go 7%. It's 7% mortgage rates. 34 million people can afford to buy a house instead of 52 million. Okay, and 92 million instead of 76 million cannot afford to buy a house. So that leaves us with 14 million new renters.
Right. Yeah.
What's that going to do with the rental market?
Absolutely. Yeah. Absolutely. That's a fantastic statistic to end with, and that number will only get worse as the Federal Reserve continues its fight, its soft fight against inflation, raising interest rates. So definitely something to watch out for. As people listen to this and want more, Jason, what is the best place for them to find more of you?
JasonHartman.com is my main website. I'm on YouTube or any podcast platform. Just type Jason Hartman and you'll find me.
Thank you so much for sharing your wisdom and your financial insights with us today, Jason. It was a blast.
It's good talking to you, Joe. Happy investing.
All right. Thanks.
Thank you so much for listening. Please be sure to subscribe so that you don't miss any episodes. Be sure to check out the show's specific website and our general website, hartmanmedia.com, for appropriate disclaimers and terms of service. Remember that guest opinions are their own, and if you require specific legal or tax advice or advice in any other specialized area, please consult an appropriate professional. And we also very much appreciate you reviewing the show. Please go to iTunes or Stitcher Radio or whatever platform you're using and write a review for the show. We would very much appreciate that. And be sure to make it official and subscribe so you do not miss any episodes. We look forward to seeing you on the next episode.